About time. June 19th is finally here, guys. Wednesday morning. There's a lot of stuff, so grab a pen and paper. Let's go through this. This is not going to be easy, but let the market bring the challenge on because we're going to role play different scenarios and we will be ready to conquer the markets in the next 72 hours. Let's go. So, number one, we keep observing some stupid behavior in the markets. They keep buying stuff when typically they would actually sell the stuff. So now this behavior lasts for 4 days straight. What we mean is they're buying the dip. And what I mean is yesterday we seen after hours, we've been watching the Adobe trade, the Adobe reaction to the news. It was absolutely insane. Yeah, the earnings per share were fine, everything's good, right? But the projections of where this company is going from here are just not good. They slashed the sales numbers. They slashed the earnings per share forecast. They guided down. When a company, specifically a growth company, guides down for the next quarter, potentially next few quarters, the stock tanks, regardless of how exceptional the earnings are actually for this quarter that they announced in the earnings for. So with that said, we've seen some insane action in Adobe, and if the market is that stupid, if the market is really that damn stupid to buy this thing on such poor guidance, then we can expect anything. We can expect the Federal Reserve to say anything, and the market would still go higher. However, we're watching Adobe for a potential reversal. We're going to go for a detailed trade that I like very much because I think investors will realize, hold on, what the heck are we doing here? And this reversal in Adobe could make us a ton of money, guys. AVGO, second day in a row, they keep buying the dip on what? Poor guidance. We've never seen this kind of stuff. Companies guiding the next quarters lower on sales numbers, revenue, that is, and earnings per share. And these things, they're buying their stocks. This is ridiculous. Facebook facing some regulations issues. Waters comes out yesterday and says, hey, hold on, Facebook, not so fast. Let us check out this crypto thing you're working on. And Facebook actually manages to squeeze out like $0.50 gain after hours. This is stupid. On the news that the stock would typically tank, they're actually buying it after hours yesterday. Now it appears that they're coming to their senses this morning saying, hold on, isn't that the reason why Facebook fell from 200 all the way to 130 because of all these regulations and privacy stuff, and now they're going to bring more scrutiny to Facebook new project? How's that positive? I don't get it. And maybe some more investors will wake up this morning and be like, what the hell were we thinking? Let's sell the hell out of this thing. So we're definitely out on Facebook. Calls from here, even though I will notice yesterday they traded 87,000 calls in the 200 strike on Facebook. Man, that is some volume there, guys, on the call side. But let's focus on some tricky stuff. Let's learn how to read this market between the lines. Point number 2. Why on earth, out of any day, Trump will pick a day to talk about his fake China deal? Oh, me and Xi, we have such a great relationship. We love each other. We're buddies. You know, oh, me and Xi, we're so good. We finally talked on the phone and things are back. I mean, it felt like we broke up for a little while, but no, me and my girlfriend Xi, we're back together and things are good again. For how long? And did they actually have this conversation, or is it just pure smoke in the sky? We don't know. But the timing of this comment by Trump, highly coincidental, right the day before the Federal Reserve is fixing to announce their decision. What does that tell you, guys? There is going to be no rate cut decision today. There's probably no going to be rate cut decision in July. There's probably going to be no rate cut decision all the way until September, maybe even December. So Trump is trying to put some juice in the market Oh, the hope of the China deal to kind of confiscate on what he truly knows and believes that, hey, there is no rate cut. There is no rate cut. The markets will tank. The question is, how stupid will the market get? Because if we're going to get the reaction like we've had in Adobe, yeah, the market is going to dip, and what they're going to do, they're going to come in, they're going to buy the damn market anyway. So that's what we got to be ready for. Now, another thing that is interesting this morning pre-market is your treasury yields are going up through the roof, okay? And why would the treasury interest rates go higher when we're expecting a rate cut? So we're seeing some divergences, guys. And gold, not down, not up, but a few dollars down. You know, if we're really going with the analogy that lower rates good for gold, the gold should be moving higher this morning. It should be. It still can possibly. Okay, but there's just too many things that are coincidental or not that are really telling us no rate cut. Now, knowing that information doesn't make us 100% successful trading, understanding this, because, again, the market is doing some crazy, wild stuff. It's doing exactly the opposite of what we typically do. It's buying stocks on the news that it typically would sell them. So maybe buying this market regardless of what news are, especially if it dips. And we're going to discuss this level. Actually, I got it right here, guys. So if we actually drop to 28.70 by 2:33 p.m., our strategy would be to actually buy this dip. Why? Because this behavior of buying the dip is just omnipresent everywhere. So we want to make our trading where institutional investors are going. Institutional investors are buying the heck out of everything. Now, we could change that going into 2:33 o'clock if Adobe's going to stage quite of a reversal between the market open and between the 2:30 p.m. So all eyes on Adobe. It's really going to tell us what is actually going to take place next. So with that said, extra low volume. Okay, over the last few days, the stocks have been moving. Yes, they've been buying the dip, but I pointed out multiple times they've been buying the dip on low volume. So what does that mean? Well, that means that all the investors that have been sitting on the sidelines, if they decide to sell when the announcement is made, we can get a sharp move lower. So assuming our calculations from yesterday, which materialized to be true, we said, hey, 29.30 is the level we're likely to go into after we break out of the 29.11. That did happen today. So we're likely to maybe trend 5-10 points before the 230. And the reason I say 230, guys, is that's where the bigger move comes. So the 2 o'clock is when the announcement comes out. 2:30 is when the press conference begins and people ask questions and they clarify things. So the bigger move is typically the 2:30, and that's more of a real move, 2:30, 2:45. So keep an eye on your phone. We will be sending some updates between 2 and 3 o'clock, specifically how we trade and everything. Bottom line is this, I wanted to point out before we go into details here, do not buy options 5-10 minutes before Fed announcement. In other words, don't do this. Don't be patient all day, and then you're like, oh man, I'm going to get this move. Oh man, I know all these divergences Leonardo pointed out in this morning video, man. Oh, I know this sharp move lower is coming. Here it is. It's 159. I'm pulling the trigger. I'm buying these puts, and this is what I'm going to do. This is how tricky I'm going to get and sophisticated today. I'm going to buy puts, and then I'm going to buy calls. Guys, it sounds fine. Don't do it 5-10 minutes. Don't do it at 159 because the options pricing is going to be the highest at that point. So typically, if you've been a very active day trader, maybe you put some similar trades like that in the past, you would know, and hopefully you would have made that observation literally 5 to 10 minutes before 2 p.m. So 155, 157, 158. These option premiums, they spike higher. They go substantially higher, and then right after the announcement is made, they deflate in value. So do not make that mistake, because even though you could be correct on the direction, because you've paid too much 5 minutes preceding the announcement, Okay, you know, if the magnitude of the move is not huge, then the options could actually be worth less than what you've paid for them, even though you were right about the direction. So don't do it. The better strategy is to wait till after the announcement, time the initial reaction, do the opposite of what the initial reaction is. Okay, and in this video, we're also going to touch base upon the gold trade, Adobe, and VIX trade all the way at the end. So, highly controversial trade on gold. This is what we're looking to do this morning. Observing the divergence in the treasuries, what we're actually going to do is we're going to short gold. I know you're thinking like, man, you were talking about buying gold. Yes, we were talking about buying gold if it does what? There was one crucial condition, guys, to buying gold futures, and that was strong breakout of the 1350, 1360 level on the way higher. So far, we're trading in the 1340s, 1345, 1350 without that substantial breakout higher and strong volume. So until the breakout high happens, I think the initial reaction of gold to the Federal Reserve announcement is actually going to be lower. So we are looking to buy gold futures 1350 strike, but we're looking to close them around 1320 because we think gold can actually drop 20, 30 points from here. And then we're going to wait out a few seconds, maybe a few minutes, maybe a couple hours. And then we're going to start buying calls around 1300 level, 1320. Now, when we're doing that, it would really pay. Remember, things do climb much slower than the time it takes for them to drop. So when you're buying the calls, you want to give yourself a little extra time. So instead of buying weekly, it may make sense to buy a monthly contract or something like that. But when we're shorting gold, we want to buy this week expiration. So the short expiration contract, you can find that. Now, the question I forgot to address yesterday was why would you want to go with gold futures, bond options on those opposed to, just some other instrument? And so let's review those other instruments. As a matter of fact, the easiest ones that I would recommend and not recommend, I'll tell you which ones they are, is gold, ticker GOLD. Used to be an awesome stock before it got acquired by Barrick Gold. This stock used to actually trade at $80, $90, $100. Used to be my favorite to trade, but since Barrick Gold acquired it, what they've done is actually transferred the ticker gold to Barrick Gold, so it's not the same company anymore. And this one trades around 12, 13, 14 bucks, and it's just the volatility is nothing. So I noticed a comment in the chat the other day, and it was like, well, I need to find cheap options or some to the extent of that, or I can't buy these options because they're too high. Or, hey, look how these, actually, this is what it was. It was, look how cheap these GLD options are. Meaning like, hey, I can buy a bunch of this, and if the trade works out, man, I'm going to make a ton of money. Guys, it does not work that way, okay? So cheap options is not a good characteristic, so be extra skeptical. So when you're looking at GLD options and they're priced for 30 cents, 80 cents, 90 cents, whatever the case may be, the strikes you're considering, it is because it is a very low volatility instrument. It is exactly the opposite of BYND when you're looking at GLD. So the reason options are priced because the market participants are pricing a rather small movements in that particular ticker. So you don't want to just look at what options are priced at. What you want to look at is what options are priced at in relation to the move that the thing that you're looking to trade is looking to make. So if BYND, it may appear like the options are high, but when you consider the price of the option in relation to the type of move, the magnitude of the move that the stock can make, they're actually cheap. Yeah, dude, what are you talking about cheap? They're like $1,500 for one. Yes, but if this thing moves 50 bucks, which it's likely to do, okay, on any given day, then your option is going to be worth 45, 50 bucks. So that's a 300-400% return roughly. Okay, so look at it. But if GLD, you bought it for 80 cents and the thing doesn't move or move very little, okay, so the next day you can sell them for $1. What's that? Which one is actually cheaper? Well, BYND is cheaper when you make the right type of comparison. So don't look at the price. Look at the price in relation to the magnitude of the move. And typically when options are trading at a higher price, it is because the market participants are expecting the bigger move. So when you're the only one expecting the bigger move, it's an issue. Okay, because it's really like, I don't know, going to a casino and like, oh, hey, let me put this on red or black or, no, even better, just put it all on 36. Okay, you're the only one hoping that it's going to hit 36. It barely ever works. Never. As a matter of fact, almost close. I mean, your probability is like nothing, right? So you don't want to use that. You don't want to buy options just because they're cheap. Always look at what you're paying for them in relation to the potential move. And if you the only one pricing a bigger move, then it's a problem, because then it's not really a strategy. It's more like hope for gain. We don't want to be hopeful. We want to make sure that we look at enough data and things to really say like, hey, there's a good probability here. Okay, so as far as gold, low volatility instrument, don't trade it. GLD, low volatility instrument, don't trade it. Or if you trade it by longer time expiration and buy in the money. Out of all of them, this is probably my favorite. RGLD trades at 96 bucks, but it's against the level. So if we do get a huge breakout in gold prices, this could go to 110, 120 bucks easy. But it's hitting that level, right? Historically, RGLD actually never traded higher than $99 in the history of the company or the stock period. So it's getting really close to that level. However, last time it traded at $99, gold prices were at 1,700 bucks. So this time it looks like it's getting ahead of itself. So my strategy would be to bet against the fact it's going to break that 100 level. Chances are it's going to get there. It's going to stall out and break lower. So here's the deal. Just remember this, guys. Pay more, make more. All right, so here's the trade. We mentioned about it yesterday. Gold has such a strong, and please don't confuse gold, G-O-L-D, stock with actual gold futures. So as you can see, there's a dollar sign here. So this is actually gold futures. And if you don't put a dollar sign, it would pull up the actual stock, Barrick Gold. So just keep the difference in mind. So we're looking at gold futures here. They got a level of 1350. We're saying it's not going to break 1350 today. Initially, we're expecting a drop. If you can focus on these candles, what kind of candles are these guys? Guys, you got to know the basics, right? Go back to the chart divergence course. Understand the black candles phenomena. Understand you really need to get this information because you want to be able to do this stuff on your own. So you want to be able to pull up a bunch of charts and see what exactly is going on. Well, in this particular case, we're getting a ton of bearish reversal candles. Look at this. Every time it gets close to that level, this thing gets shut down and comes back to earth. So the probability as such, it's not going to make a big move today above 1350. It's actually going to make a pullback towards 1320, 1310. So we want to short it while everybody screams buy gold. We want to short it. Okay, it's going to come down. It's going to give us a better ability to actually come in on the call side and make a much better entry. So that's the gold trade. Let's move on. Okay, the market was going to make an attempt to break out above the higher trading range. And the key word yesterday, guys, was an attempt. It was going to make an attempt, and it certainly did make an attempt. It did break above 29.11 yesterday, and it did hit that level of 29.30. So what do we expect today? Well, we're expecting that the market could actually drop back to this area of 28.70 after the Federal Reserve minutes. We're also expecting a possibility that the market could retest 29.50. And the simple strategy is, guys, your homework was to watch market move 9 and 10 in the 13 markets move formula so you would know exactly how to trade this type of situation. So I'm not going to spend a lot of time. I'm going to move on to the Adobe trade. So considering Adobe 290, 295 puts at the open. So far, at the time I'm recording this, it trades about 288, 289. Ideally, would like to see it get above 290, maybe 291, 292. That would be my perfect entry to come in and short the hell out of this thing. I know this resumes, looks like a move 13, which it is, but some of these things, they're not sustainable considering the context. You should always consider the context. So some of the most powerful move 13s are when something keeps dropping for a while. This is not, the pattern of the move 13 is here. However, when we look at the context, we're finding exactly the opposite situation here that could materialize, which is why this trade could be very interesting. So initially, the reaction is true that this thing drops from 277 to 266, and then they buy it up like crazy on bad guidance. This never happens. I mean, so I think this initial reaction, the people that were getting out, they're wondering what are the rest of the guys are smoking that are, that are buying this thing after hours yesterday, pre-market today. Basically, if this reversal happens, we're likely to revisit this level of 266. So maybe first target should be 270 close. When this thing reverses, goes back to 270. Second target like 265, 266 area. But here's what making us bearish on this thing. I mean, if you look at this, it's a clear multi-top formation. Okay, the distribution accumulation. Okay, people are starting to get out right here. We've got a level that the stock has never taken out, that 290 level, and it's going to come against that level after already a move of about $12. So yesterday the official close was 277, and we dropped to 266 right after the announcement. But so far this market we're at 288, 289, so it's like $11, $12 higher than where we closed yesterday. If you look at the history of Adobe, it does not make moves bigger than $11, $12, period. So we've already kind of maxed out that move. So ideally, if we can stretch that out another dollar or two, that's officially going to make it one of the biggest moves on this chart. And at that point, the probability of it moving substantially higher, like 295 would be it. So I'm going to start buying these puts at 290, 292, 295. Only if we break above like 297.50, I would consider cutting the trade. But in that context, where historically the stock has never broken above that level, we're actually getting poor guidance, and they're doing a stupid thing buying it. I would love to come in and short the heck out of this thing right here. So that's going to be my entry, 290 to 295 area. It's going to be my exit, but I am going to start taking some profits when it hits the 270 mark right here. So if we take a look at the weekly, on the weekly chart, we've got a clear divergence between the strength. So now the stock goes back to these 290s levels where it was a year ago, and the strength is just not there. It's just not there. And the strength is not there coincides simultaneously with the fact that the volume keeps dropping off. So now when the stock moves back to these levels of 280, 290, the volume, the buy volume is just dropping off. It's consistently going down. Also coincides with the bearish MACD. Guys, I like this trade a lot. Now, if it does not reverse, it really confirms how stupid this market is. And no matter what the Federal Reserve announcement is, we're buying calls. So we're using Adobe as a strategy to really tell us what's actually going to take place in the market next. Okay, yesterday was a move one. Nice and easy. The market pops higher. Here's your gap up higher, moves higher, and sustains that move higher throughout the day. Clearly, a couple of instances where it looked like the market was making a dip. What did they do? They bought the dip. 2-day sequence, 5-1, all green. Here's your move 5, nothing's going on. Here's your gap up higher, move higher, and sustainability of that move higher. 5-day sequence, 11, 7, 5, 5, 1. The bulls appear to be in full control, but are they? If we don't get a break above 29.50 by tomorrow, technically, if the market's reaction to whatever announcement comes out is positive, we should easily take out that 29.50 level today. Now, if it does not happen by tomorrow, definitely something is wrong, and we could easily revisit the levels of 2,700. So if we are approaching this 29.50 and lower volume today or tomorrow, we are actually shorting the heck out of this market in the expectation that this move is not going to be sustainable, because literally it would be like more like a multi-top formation quadra top at this point, on the S&P futures. So this is exactly what we're seeing the market could very likely do if the initial move is higher. So if the initial move is higher to 29.50, we got a setup that just highly resembles this thing that we just had about a week ago. So can we move to 29.50? Yes, but once we did, see that last move higher right here, followed by sort of a gap up higher, and then we've done this double top, triple top formation, which was all moves 11 to 11. They were right there. So I think we could be going back into this 11 to 11 kind of situation here. So I'm definitely looking out for that. That would be an awesome thing if that materializes. So it is all contingent if the initial reaction is higher. We're going to take a closer look at that in a bit. So the market move for today, clearly, if you studied the 13 markets move formula, which I hope everybody did at this point, you guys should really take your time to go through the details, because it's the little details that make you a lot of money. Okay, so move 9 or 10 for today is our projection. VIX is still sort of in a crash mode. It is numerically low. This isn't a downtrend, but could we actually capture a TRO, a trend reversal opportunity? I think the answer is yes. So we are considering buying VIX calls at the open, closing half of them at 1:58 p.m. I hope you were paying attention, because why would it be closing them at 1:58 p.m.? Because at that point, right before the announcement, option premiums are going to spike, so it creates the best opportunity to actually sell some. So if we don't know the initial reaction after the announcement, it would make sense to sell half of the position at 1:58 p.m. and then keep holding on the rest of the position till tomorrow, Friday. So typically VIX will spike. The only thing we don't know is by how much, depending on how the market responds to the announcement. So holding some VIX contracts when things could get rather volatile within a very short amount of time is a reasonable trade. Okay, this is basically how it looks on the chart. VIX dips below 15. Pre-market yesterday catches some ground here, basically holds at 15. Our first target in the VIX is going to be 16.53. If it breaks above that, second target is 17.73. So we could easily see VIX at 16.53 going into the announcement. We're going to sell some there. We're going to hold half of the position till we hit this level of high. Okay, nice and easy. So key takeaways, guys, is trade the opposite of the initial reaction. So I said I was going to give you more specifics on that. So initial reaction could be lower. So if the initial reaction is lower, we're likely to hit this 28.70. If we're in this 28.70, we're buying calls. Nice, sweet, and simple. If the initial reaction is higher to like 29.50, and specifically on lower volume, in other words, we don't have many believers that were standing on the sidelines, coming in and just buying the market up, then we want to buy puts. 29.50 is the area where we want to buy puts, maybe 29.50. Building the position to the 29.55, 29.60 level in the expectation of reversal over the course of the last few days. The one barometer we're looking at in order to do this is, will VIX break above 16.53 today? If the answer is yes, clearly when the market goes to 29.50, we're buying puts, collecting some nice healthy gains by Friday afternoon. Nice, sweet, and easy, guys. That's how we do it at Trading Options Live. Let's rock, make some money out there. I'll see you guys in tomorrow's video.